Ever looked at a stock and thought, is this actually worth buying? It's a question that can make or break your entire portfolio, and honestly, it's the difference between building serious wealth and just throwing your money into a financial black hole, hoping something good happens. We see the headlines, we see the hype, we see stocks going to the moon, and it's incredibly tempting to just jump in without a second thought. But that fear of missing out, or FOMO, is one of the most dangerous emotions in investing. It pushes you to make impulsive decisions based on what everyone else is doing, not on what the actual company is worth. That's a recipe for disaster, and it's a mistake I see people make over and over again. The truth is, blindly buying a stock because it's popular, or because you saw a flashy news segment about it, is no different than walking into a casino and putting all your cash on red. You might get lucky once or twice, but over the long term, the house always wins. The stock market isn't a game of chance, it's a game of skill, patience, and most importantly, knowledge. The professionals, the ones who consistently make money year after year, aren't just getting lucky. They have a system, a checklist, a process they follow religiously to separate the winners from the losers. They don't guess, they analyze. They don't hope, they investigate. And that's exactly what we're going to break down today. Today, I'm going to pull back the curtain and show you the exact framework that professional investors use. You'll learn the 5 key things pros check before buying any stock, and how you can use them to invest smarter starting right now with absolutely no prior experience. We're going to demystify the entire process, cutting through the confusing jargon and getting straight to what actually matters. This isn't about complex algorithms or needing a PhD in finance. This is about applying a common-sense approach to understanding what you're actually putting your hard-earned money into. By the end of this video, you'll have a repeatable blueprint to research any stock with confidence. So, if you're ready to stop gambling and start investing like a pro, make sure to stick around. Maybe gently tap that like button for the YouTube algorithm, and let's get right into it. We're going to transform the way you look at the stock market, giving you the tools to make informed decisions that can help you build long-term sustainable wealth. The goal here isn't just to pick 1 or 2 winning stocks. It's to develop a lifelong skill that will serve you for decades to come. Let's begin with the absolute foundation of smart investing. Understanding what stock research actually is and why it's non-negotiable. So what is stock research? It's analyzing a company to see if its stock is a good investment. Like inspecting a house before buying, stock research involves looking at a company's financials, management, market position, and stock price. The goal? Understand the business well enough to predict its future growth. Without research, buying a stock is gambling. Research transforms you into an informed investor who understands the why behind their investments. The purpose is to build an investment thesis, a clear explanation of why you're buying a stock. This thesis guides your decisions and helps you stay rational. Peter Lynch swore by a simple rule: if you can't explain a company in 1 sentence, don't invest. Apple? They design and sell premium electronics and services. Starbucks? They sell coffee and snacks globally. This ensures you invest within your circle of competence. Describe how a company makes money in 1 sentence. Understand what they sell, who they sell to, and how money flows. Who are their customers? Look at competitors. Who else solves the same problem? What makes your company better? Where are competitors stronger? Understand competitive dynamics. You've found a company you understand and can explain. Now let's look under the hood to see if it's profitable using financial statements, starting with the income statement. It's a report card showing revenue, expenses, and net income. Look for consistent revenue growth and positive net income. Also check the profit margin. Shrinking margins are a red flag. Next, the balance sheet shows assets, liabilities, and equity at a point in time. Assets equal sign liabilities plus equity. A key metric is the debt-to-equity ratio. A high ratio can be a red flag. Finally, the cash flow statement tracks cash moving in and out. Focus on cash from operations. It should be positive and close to net income. We've confirmed the company is financially healthy, but can it keep doing this long term? This is where a competitive advantage, or moat, comes in. Like a moat protecting a castle, it protects profits from competitors. Coca-Cola has a powerful moat, its brand. Google for search has achieved something special. Another moat is the network effect. Patents or intellectual property are also moats. Another is a cost advantage. Finally, high switching costs. This is a sign of a high-quality business. So we've found a business we understand, it's financially sound, and it has a strong competitive moat. We're getting really close, but there's one more critical qualitative factor we need to consider: the people running the show, the management team. You can have the best business in the world, but if it's run by incompetent or dishonest people, it can be driven into the ground. Conversely, a brilliant and dedicated management team can take a good business and turn it into a phenomenal one. Evaluating leadership is more of an art than a science, but it's a step you absolutely cannot skip. The first person to look at is the CEO. Who is this person? What is their track record? Have they been with the company for a long time, or were they just hired from the outside? I personally love to see founder-led companies where the person who started the business is still running it. Founders often have a deep passion for the company, a long-term vision, and a huge personal stake in its success. Think of Jeff Bezos at Amazon or Mark Zuckerberg at Meta. Their interests are often deeply aligned with the interests of long-term shareholders because the company is their life's work. Beyond the founder-led ideal, you want to see a management team with a history of smart capital allocation. This means they are good at deciding what to do with the company's profits. Do they reinvest it wisely into projects that will generate high returns? Do they make smart acquisitions that actually add value? Or do they overpay for flashy deals that destroy shareholder wealth? You can get a sense of this by reading their annual reports and shareholder letters. A great CEO will communicate clearly and honestly about their strategy, their successes, and just as importantly, their failures. Warren Buffett says he tries to invest in businesses that are so wonderful that an idiot could run them, because sooner or later, one will. While that's a great rule of thumb for finding businesses with wide moats, I'd rather not test it. I want to see a team of A players at the helm. I want leaders who are not just competent operators, but also excellent capital allocators and, above all, trustworthy. Your investment is, in many ways, an investment in them and their ability to navigate the company into the future, so you need to be confident they're the right people for the job. It's not enough for management to be smart. They also need to be aligned with the interests of shareholders like you and me. We need to know that they are working to increase the long-term value of our shares, not just to enrich themselves in the short term. One of the best ways to check for this alignment is to look at insider ownership. How much of the company's stock does the management team and the board of directors personally own? When a CEO has a significant portion of their own net worth tied up in the company's stock, they have some serious skin in the game. When management owns a lot of stock, their incentives are directly aligned with yours. When the stock price goes up, they get richer. When it goes down, they feel the pain right alongside the other shareholders. This makes them much more likely to think like owners and make decisions that will benefit the company over the long run, rather than chasing short-term metrics to boost their annual bonus. You can find this information in the company's proxy statement, which is filed annually with the SEC. High insider ownership is one of the most bullish signals you can find. Another great sign of a shareholder-friendly management team is intelligent stock buybacks. A stock buyback is when a company uses its cash to repurchase its own shares from the open market. This reduces the total number of shares outstanding, which makes each remaining share more valuable and increases earnings per share. However, this is only a good deal for shareholders if the company is buying back its stock when it's undervalued. If management is buying back shares when the stock price is at an all-time high, they're essentially overpaying and destroying value. A smart management team will be opportunistic with buybacks, ramping them up when they believe the stock is cheap and slowing them down when it's expensive. This shows they are disciplined capital allocators who are truly focused on creating long-term value for the owners of the business. On the other hand, a management team that constantly issues new stock options to themselves, diluting your ownership, and then uses company cash to buy back those shares at a high price is a massive red flag. It's a subtle way of transferring wealth from shareholders to themselves, and you should run the other way. To truly get a feel for the management team, you have to do a little bit of reading. I'm talking about the annual shareholder letter, which is usually written by the CEO and included at the beginning of the annual report. This is management's chance to speak directly to you, the owner of the business. A great shareholder letter will be clear, candid, and focused on the long term. It will explain the company's strategy, celebrate its successes, and most importantly, own up to its mistakes and explain what was learned from them. I highly recommend reading Warren Buffett's annual letters for Berkshire Hathaway. They are the gold standard. He writes in plain English, avoids jargon, and is brutally honest about both his triumphs and his blunders. When you read a letter like that, you build trust. Compare that to a letter full. So you've found a great company, but is it a good buy right now? Valuation is critical. Finding a great car doesn't mean it's a great deal. The same applies to stocks. We want great companies at a fair price. Valuation determines a company's intrinsic value compared to its stock price. We'll break down common metrics like PE ratio, PEG ratio, and price to sales ratio. Used together, they show if a stock is on sale, fairly priced, or expensive. Let's get into it. We've covered a lot, but you don't need expensive tools for professional-grade research. Incredible free tools are available. Start with Yahoo Finance for a quick company snapshot. Type in a ticker and you get a dashboard with the stock price charts and key stats. The Financials tab offers income statements and balance sheets. FinViz is great for screening and visualizing data. Its stock screener is powerful. For in-depth analysis, check out Morningstar and Seeking Alpha. Use these tools for a quick company overview in under 60 seconds to see if it's worth your time. Let's analyze Nike, NKE. On Yahoo Finance, I see the price, market cap, and PE ratio. The Statistics tab shows the PEG ratio and debt to equity. FinViz provides a condensed table with key data points. In under a minute, I know Nike's business, size, valuation, and growth. These free tools are enough for most investors. We have covered a massive amount of ground today, from understanding what a company actually does all the way to analyzing its valuation with ratios like PE and PEG. It might seem like a lot, but this process, this checklist, is what separates successful strategic investors from gamblers who are just hoping for the best. It's the difference between building long-term wealth and getting burned by the latest speculative fad. So before you invest a single dollar in any company, I want you to pause and ask yourself one simple question. Do I really, truly understand what I am buying? If the answer is anything less than a confident yes, then you have more work to do. But now you have the exact framework to find those answers. Let's quickly recap the checklist. First, know the business inside and out. Second, check its financial health. Look for growing revenue and manageable debt. Third, identify its competitive advantage or moat. Fourth, evaluate the management team. Are they experienced and aligned with shareholders? And fifth, understand its valuation. Are you buying it at a fair price? This is your 5-point inspection for every potential investment. I want to encourage you to use this checklist before you make your next trade. Pull up a stock you've been thinking about and run it through these 5 steps. It will force you to think critically, to look past the hype, and to make decisions based on data and logic rather than emotion. This is how you stop guessing and start investing like a pro. It takes a little bit of effort up front, but the confidence and the results you'll gain are more than worth it. Your future self will thank you for taking the time to do it right. If this video helped simplify the world of stock research for you, do me a huge favor and smash that like button. Drop a comment below with the stock you're researching, and make sure you subscribe to invesYou, the channel where your money meets strategy. Thanks so much for watching, and I'll see you in the next video.